Hey everybody, welcome to the Mortgage Today for Thursday, July 13th, 2023. And oh, what a day it was. MBS enjoyed a 30 basis point gain this morning. Stocks were up 23, so that's a win-win for everybody. Bonds extended the gains overnight in a self-reinforcing move, with treasuries responding to EU bonds, which in turn were responding to yesterday's treasury trading. A bit of oversimplification, as Europe was still trading when CPI came out yesterday, but you get the idea. There was also a comment from an ECB speaker about the rate peak being fairly close. We also got jobless claims came in at 237,000 on a 250,000 forecast. Producer prices came in at 0.1 on a 0.4 forecast. On a year-over-year basis, the core was 2.4 on a 2.6 forecast. So jobs would have hurt bonds, but then we got the PPI, which kind of helps give a better impact on inflation. Kind of offset each other, so the AM data didn't produce a huge reaction, but there's been a bit of selling on the stronger jobless claims. It was partially offset by those lower PPIs. Yesterday, we also got June inflation fell at 3% year over year from 4% in May, and from a peak of 9.1 in 6 of 2022. While core inflation rose only 4.8% year over year, it's more than double the Fed's 2% target. Moreover, the Fed's favorite inflation gauge, which is services inflation minus housing and energy, was almost unchanged from May. The big decline in headline inflation was primarily because of energy was so expensive a year ago and the comparison effect. So things aren't any cheaper, it's just we're comparing to a different number. So the battle is not over. The Fed also released the Beige Book yesterday, which is a survey of all of the regional Fed districts. Overall economic growth is increasing modestly. However, consumer spending was mixed, with more being spent on travel and less on discretionary goods. Demand for real estate remains strong, albeit constrained by limited inventory. Bonds put on a nice day of gains after a mixed performance in the morning's economic data. Jobless claims made a case for higher rates. Producer prices argued for a rally. Based on the past precedent for each report, you wouldn't be wrong to expect there to be more of a wash than a 10 basis point drop in treasuries and a half-point rally in MBS, but that's what we got. But why? We'll be able to piece this together better in the coming days, but rationale ranges from European influences to an overdone sell-off last week. We can also throw in supply considerations, as markets just made it through treasury auctions for the week, in addition to quite a few corporate bond offerings. At the end of the day, bonds improved by 42 basis points net. Stocks improved by adding 37 points in value, which brings our 5.5 UMBS up to 100.03. So we got back above that 100 point, which puts us right in the thicket of all of these converging variables. So we are just slightly above the 50-day moving average and just slightly below the 100 and 200-day moving averages. So hopefully we can just kind of stay in this range and ride it out for a little while. That would be pretty cool. And the second version of the same draft. Also saw this graph today and I thought it was interesting, so I thought I'd share it to you, and this is a good for perspective. Is everybody's crying in their beers lately? We are actually pacing to have the fourth best year in mortgages since 2002. So historically, things are actually pretty good out there. So just go get more business. If you need help doing that, check out our sponsor at wellthatmakesense.com. This is another blog post from the series on Alex Hormozy, which is all about trying to find what to optimize for. What is the thing that you can do longer than anybody else, where it looks like work to other people, but to you it feels like play? This is the big thing. Look for what that is and optimize for it. That's how you get rich.